Hello traders, Gary Wagner here for Trending Markets. It's approximately 11:30 in Honolulu. It is 4:30 in New York. Dow Jones Industrial Average is up on the day, closing higher on the day, but well off of the highs of the day, closing up about 82 points at 17,574 and change. Now the low of the day is 17,474 and the high 17,697. So we've seen quite a nice range in the marketplace today, but as I said, closing well off of the highs of the day, and that has absolutely affected us because we did send out a trade alert this morning, and that recommendation on the trade alert was to enter a long position in the Standard & Poor's vis-a-vis the E-mini, and the market was trading roughly at 2063, a long ways from here. We also recommended putting a stop below the 200-day moving average, which was sitting at 58. Traders taking that call got in at 2063, got knocked out at 2057 for a loss of 6 points on the trade. I apologize about the trade, but after having three substantial winning trades in a row in the S&P, a small drawdown is all part and parcel of the game, although I wish it hadn't been that way. I do want to explain what we were looking at, what our rationale behind putting the trade on, even though we were stopped out, and also talk to you about our upcoming strategy, all on today's daily report. So traders, in terms of the strategy that we had today, it was not successful, but I do want to go over why I issued the trade alert that I did. We're looking at a daily chart, standard candlestick format. You've got two basic moving averages here. The blue line here is our 200-day moving average. Our dotted red line here, that is our 50-day moving average. Also, we have a fib retracement which goes from these lows here at about 1831 up to these highs at 2109. When we do that, we do get different areas, and we have a 23% retracement area at 2043.95, so call it 2044. So when the market traded below these points over the last 3 days, we had three strong selling days. Of course, we exited our last trades and nice profits up here. But my sense was once we dip below this particular point, because now we have come under the 50-day moving average, that if we break hard below this, and this is what I said yesterday, if we break hard below this point, my sense is we're probably going to drift lower. However, if we can find some support in this area, then that tells me that we're holding above not only the 50, but the 200 long-term moving average, and we could go back into rally mode. Now, as the market was trading today, and really to illustrate that, you can see the chart that I sent out, but when the market was trading at around 63, it was definitively above this particular price point. Now, the high really came out to be about 2067. We took a stab when the market had just broken above this point right around here, and that was my sentiment. However, I also believe that if it could not sustain this market move, we would have a tight stop. As you know, the stop that I placed today was much tighter than I typically place, because my sense was that it needed to close above the 200-day moving average. We certainly didn't get that. You can see this daily candlestick right here, although it is green, meaning it has closed higher than the open, it is well off of the highs, and more importantly, it is right at the 50-day moving average, but well below the 200-day moving average. So that was the basic sentiment behind that. As I said, we did get in, we did get stopped out. I apologize for that, but the strategy and the thinking behind the trade, as I just outlined, I still think was valid and rational. It just didn't pan out. So traders, in terms of other markets that we do look at, we do have up the dollar index right now. Dollar index up strongly on the day, up about 0.62% in terms of the net gain, 97.94. If we take a look at this one particular chart, and this of course has the dollar on the top and the euro on the bottom, you can see that the euro under pressure today, hitting a top just above 110, now trading at 109.40, and the dollar index back up off of these lows just above 97, currently trading at 97.94, so just below 98 on the dollar index. And 98 is really 97.92. That's a 38% retracement. So we are just a tick above that, so call it at that particular point. Resistance in the dollar index I currently have pegged at around 99, and support has to be based on these recent lows here, so call it 97.20 in terms of the support side in the dollar. Again, we have the FOMC meeting, last one of the year, scheduled for next week. If we do get liftoff and we do have the Fed actually begin to hike interest rates up, that should be extremely bullish for the dollar, and we should see follow through, although this market has been a whipsaw market when you consider the magnitude of some of the moves that we have seen, both to the upside as well as the downside. This has been Gary Wagner, wishing you as always good trading. I apologize for not bringing that to you today, but we'll get back on it as early as tomorrow. Bye-bye.